I'm Max Keiser. This is the Keiser Report. The winds of change are blowing. You know, some people say that you don't really know what a new century is about until like the 13th or 14th year. Here we are, 2017, and we're starting to see what the 21st century is all about. And it ain't like the 20th. No, no, no. Stacy.
The good thing about having an international show is that we get to celebrate all the Christmases, all the Hanukkahs, all the Eids, all the New Years. There are many New Years. We already had the Western New Year, we had the Russian New Year, and now I want to get a jump start on the Chinese New Year, because the Chinese New Year goes from the 27th of January through the 3rd of February, right after Trump is inaugurated. And one thing about the Chinese New Year, if I have this correct, they believe that they start the year as they mean to end the year. So how they start the year is a sort of precursor to what the year will be like. Trump is coming in. What is he going to do? Is he going to name them a currency manipulator? Is he going to start a trade war with them? Well, let's look at what's happening in China. No Happy New Year in China as currency liquidity fears loom. China bulls could be facing a grim New Year's Eve. That's because the first day of 2017 is when an annual $50,000 quota to convert the yuan into foreign exchange resets, stoking concern there will be a rush to sell the local currency, with tax payments and a regulatory assessment also tightening liquidity in the money market toward year-end. January may bring scant relief as lenders prepare for stronger cash demand before Lunar New Year holidays, which are only a month away.
Is it bull in a China shop, or is China going to be impacting the bull? Is it going to be the beginning of a new century, or hey, this is the Chinese year of the what? What's the animal?
Oh, you know what? I don't know. All I knew was that it was the year of the monkey last year. Oh. So I think it's the year of the chicken or something that comes after that. My little sister.
I know I'm the year of the boar or pig, and wild Chingalia, the same Eastern astrological sign as Humphrey Bogart, I believe. Kind of interesting. But yeah, so this China story is interesting. It comes at a propitious time in the cycle of finance, because China now is entering into a period where people are questioning the validity of that market and of that growth rate. And Trump is, picking a trade war or a currency war. And so, yeah, this could be center stage. This could be the fight of the new century.
Well, it saw 2016, the yuan was down 6.6%. And now remember, this is something Trump is saying, that they're manipulating their price down. Some people, many people in the markets, analysts say that, in fact, they're having a struggle keeping it from falling faster. The Chinese bond, the 10-year government bond, surged 21 basis points in December alone. So they were struggling. They're saying there's signs of a liquidity crisis there. Remember, we saw a liquidity crisis at the end of the year in Italy as well, regarding their oldest bank, Monte dei Paschi. Here, where the data at the People's Bank of China is showing that there's also a huge capital outflow there happening. So, we're entering into a crisis. Bad winds.
Yeah, there's a barometer for all of this. Typically it would be gold. Or silver. We've seen some problems in that market in terms of prices being manipulated by the money center banks and the bullion dealer banks. But clearly in the case of Bitcoin, which is independent of all that, it's hitting new all-time highs in terms of its market capitalization. A lot of that is flight capital from China. So so what's going on in China? People are scared. That's what's going on. So, we can look at the numbers and say, well, maybe the numbers are a massage, maybe the numbers aren't giving an accurate picture, or we've seen this before and the growth rate's really there. Fact is, people are running for the hills. They're getting out of China. The people there are afraid of something. It's like that movie Men in Black, where they look at the map of the aliens. They're scattering to all corners of the galaxy because they know something's bad is coming.
Well, something bad already happened at the end of the year, and this could be a precursor to what 2017 holds for all of the, there's a lot of debt and credit and bonds between China and the U.S., and there's this notion of fake news. Remember, we ended 2016 with a notion of fake news. So what is 2017 going to hold in terms of that? Well, fake prices, fake bonds. Billionaire Chinese tycoon Wu Rulan defaults on 100 million yuan of bonds owed to retail investors. The chairman of telecom company Keiser Group, reportedly richer than Baidu CEO Robin Li, cited tight cash flow for the default. So the way that the local papers, the South China Morning Post cited it, they said, a super rich Chinese businessman has defaulted on bonds worth 100 million yuan that he raised from retail investors, citing tight cash flow. What does that sound like?
Oh yeah, in 2008, remember the debate? Solvency versus liquidity?
Yeah.
People said, oh, no, it's not a solvency issue, it's a liquidity problem. And trying to mask the fact that these banks are insolvent by saying we just need to give them more money. That way they will be able to cover their liquidity crisis, but underneath that liquidity crisis is a great functioning solvent enterprise. Of course, that was complete nonsense. The banks are insolvent then, they're insolvent now. These Chinese institutions are completely insolvent. And as far as fake news goes, I mean, China is the king of fake stuff, right? I mean, all the fake Gucci bags and all the fake pork buns that they sell on the street made out of cardboard, and everything there is fake, it's counterfeit. Alibaba, the big retailer that competes with Amazon, is under scrutiny for selling many, many, many fake items.
Well, let me bring that in. You mentioned Alibaba because they now enter the story, because that was just the headline news. There was a cash flow problem with one of the richest men in China, and then lo and behold, it's worse than just cash flow, because remember, you bring up the 2007-2008 crisis when is it solvency, is it an insolvency issue, or is it a liquidity issue? Well, it turned out to be kind of a fraud issue, because a lot of the derivatives that had backed the global financial system were fraudulent. Well, here, it turns weirder. As mystery of China's multi-billionaire default deepens, a new, quote, bond scare emerges. Reuters added to the mystery of this story of one of the richest guys defaulting on his bonds when it said that the fate of the defaulted $45 million Chinese corporate bond sold through an Alibaba-backed online wealth management platform was thrown into doubt on Monday after a bank said letters of guarantee for the bonds were counterfeit. Quoted by Reuters, China Guangfu Bank said guarantee documents, official seals, and personal seals presented by the insurer of the bonds are, quote, all fake, and that it has reported the matter to the police.
Look, China's not a long-standing practitioner of capitalism. You know, they just came out of their communist funk very recently. So this idea of securities and forex trading and markets and due diligence is new to them, and mix that with a kind of a culture of gambling with another subculture of fraud, and you end up with this toxic stew of toxic securities. Now, sticking on this fake news for a second, you know, nobody really paid attention to last year's story about Forbes, and they ran news that was written by robots, algorithmically generated news, that they are generating by just looking at prices, and then they create the narrative to go with the prices. Now, what happens is that algorithmically generated news story is then picked up by bots on the New York Stock Exchange, algorithms or robots on the New York Stock Exchange that trade stocks based on what they're, and all the trading on the New York Stock Exchange are by bots, 85%, by reading the stories that are written by bots. And then the prices change based on how the bots are trading, and then that price change is picked up by the bots over at Forbes magazine, and they write a news story. So you have a circle of fake news and algorithmic news and robot news feeding each other, and that is not representative of any economic reality whatsoever.
Yeah, and that's one part of the equation, because that's driving the stock markets, but then this side of the equation is bond markets, and we saw in the 2007-2008 crisis, all those bonds, which were those CDOs, which were the mortgage-backed security bonds, those were all fraudulent. Here it looks like China, remember Yankee, when you call Americans Yankees, that was apparently some sort of Dutch term for basically counterfeiters, which the Americans were at the time, that we were counterfeiting.
Right, I mean, China says, like, we're huge polluters, but so was Britain, you know, during the Industrial Revolution. And yeah, we create false securities, but so did America and England back in the, you know, the creation of listed securities markets. So we're just doing what you did. But, you know, they're doing it with, you know, $17, $18 trillion worth of securities, and they're doing it in a way where the interconnectivity of the global economy means that all of the globe's various markets are now infected with the disease that is Chinesism. And here comes Donald Trump. Now, how's he going to handle this? You know, it's going to be interesting.
Well, here's another story related to that, because it also brings us back to 2007, 2008. Is this going to be a new Trump-led, you know, because remember 2007, 2008 was the end of the Bush administration, the beginning of the Obama administration. Here's the end of the Obama administration, beginning of Trump administration. Are we going to have another global financial crisis? Markets were rallying like like heck. You know, they were booming at the end of 2016, or they, not since Herbert Hoover in 1928, and then of course the 1929 crash happened. And one of the things that happened in 2007, 2008, many people overlook, is a crash of Dubai, the Dubai real estate market. But talking about solvency, liquidity, Abu Dhabi is in the headlines here. I thought this would be interesting to you because we've talked about short selling quite a lot. Abu Dhabi to permit short selling, an attempt to boost liquidity. Abu Dhabi is poised to introduce services facilitating short selling next year as it seeks to boost trading volume and attract foreign investors to the illiquid market. Boosting liquidity in share trading is one of the biggest challenges for local regulators and stock exchanges in the Gulf. Since the start of 2015, the stocks of at least half of the 62 members comprising the ADX General Index have finished each trading session unchanged because short selling is not allowed.
Yeah, well, I will point you to Japan circa 1989. Up until then, there was no real short selling because all the major players, the industrialists and the bankers, would buy stock in each other and serve on each other's boards. And so it was a self-fulfilling daisy chain of, you know, self-ingratiating. And they have a Japanese name for it, which I can't remember right now, but it's definitely not sushi. And then they introduced actually futures trading and short selling in 1989 in Tokyo. And the Nikkei at that time was, I think, 40,000, and it dropped to 8,000. It was this huge crush, and they're still in this deflationary lost 2 decades in Japan because of that very moment. So if you say in Dubai they're going to introduce short selling to increase liquidity, Abu Dhabi, that, you know, we're saying that this gives sheiks and mullahs a chance to sell their neighbor short without them knowing it, because you break up the cozy relationship that existed.
Well, don't get caught short because it's 2017 and bad winds are blowing.
Oh my God, sounds fantastic. Second half, I'm talking to Konstantin Georgiev. Stay right there. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go back to Konstantin Georgiev. He is a macroeconomist, and he's over at macroview.eu. Konstantin, welcome back.
Thanks, Max.
Hey, so Konstantin, you're a macroeconomist, and so is Christy Lagarde. She's a macroeconomist. She runs the IMF. She says that the global debt stands at $152 trillion, or 225% of global GDP. Is this a lot of debt, Konstantin?
That is a huge amount of debt. That is more debt than there was debt before the beginning of the global financial crisis. So, as I said before, we're back to the situation where the debt levels in the global economy are extremely elevated. Our ability to manage that debt, or the burden of that debt, by reducing continuously the cost of that debt through the interest rates reductions is completely exhausted. The banking system is running on razor-sharp margins. Basically, there is no operating profits in the system anymore left because of the low interest rates. And as a result of that, we're having increasing levels of the insolvency within the financial system, both at the bank level, but also non-bank institutions, such as pension funds, for example, such as insurance companies as well being strained. So in other words, the system is getting weaker by the day, at the same time as the debt levels are rising continuously. What's interesting about the IMF figure is that it also shows that there has been a significant increase in terms of the debt of the emerging economies, which is a new dimension to the crisis itself. So if you take all of the global debt today as a share of the global GDP, it is in excess already by about 5 to 7 percentage points as to where it was at the beginning of the global financial crisis. And if you strip out United States and China, the two largest debt-holding economies in the world today, we are about, by the end of this year, we're about to breach that level once again, the 2008 level of debt.
Okay, you mentioned the 2008 level. Let's go back to 1997 and the Asian financial crisis. And of course, Thailand had a devastating debt apocalypse at that time. The response of Asian countries like China and the response of other countries like Russia was to build up enormous reserves. China has multi-trillion-dollar reserves. Russia is building up its reserves that they've maintained even through the period of sanctions and the slowdown due to the fall in oil prices. Are these reserves intact in any way, or have they burned through their reserves? And so isn't that a bit of a buffer, or what am I missing there?
Some of the reserves, in the case of the likes of Russia, for example, and Norway, have been both simultaneously the stabilizers to the economy during the times of the very high oil prices, high commodities prices, but they're also supposed to serve as the stabilizers for the economy during the times of the downturn. So Russia, and indeed the likes of Saudi Arabia, United Arab Emirates, Norway that I mentioned before, all of those countries are using their reserves in order to sustain the economic growth and sustain employment activity, invest in the economy and so forth. So Russia has been burning through some of its reserves. It's not catastrophic levels in terms of the burn rate, especially this year. Things improved quite significantly, economy stabilized. So yes, I mean, that's the whole rationale of those reserves. China used the same surpluses also to form the reserve, except that instead of using the surpluses from exports of commodities linked to commodity prices, it used the surpluses from the external trade, exports in other words, and it accumulates significant reserves. In the case of China, they have been using some of those reserves in order, again, to stimulate domestic economy. Most of that has gone, unfortunately, through the credit system, so the debt levels in China continue to rise. Banking debt is rising at the same time as the household debt continues to grow. Corporate debt is also growing. So in a way, China is using, I think, those reserves in a quite imprudent way, because it is increasing the overall levels of indebtedness in the real economy in China. But nonetheless, it is helping to, if you want, cushion or ameliorate the adverse effect of the slowdown in the growth rates in the global trade that China has experienced.
Okay, now leading up to the presidential election, Donald Trump made a big case about China and unfair trade practices. He, of course, won the presidency. He's soon to take office. Can you give us your thoughts on what exactly was Trump saying? He talked about currency manipulation, for example. So what was he saying? What is he saying he'll do to right this perceived wrong? And does he have a chance in succeeding?
Well, what Donald Trump was referring to is the long-standing dispute between China and the United States, the dispute which links to the valuations of yuan. For example, the United States repeatedly in the past has accused China of sustaining valuations of yuan relative to the US dollar that are too low, and as a result of it acting as a stimulus for exports from China and reducing imports by China of the goods from the United States. That dispute has been periodically settled, but currently is still at play, despite the fact that yuan is now floated, and it is much more freely traded than it used to be before, and the government control of yuan is much lower. So as a result of that, China switched in recent years, and in particular last about year and a half, into a model where they're sustaining lower valuations of yuan, not by direct interference in the currency markets, not by fixing the yuan rate, but instead by priming the economy in terms of the monetary policies. And this is increase in credit supply within the economy that the Bank of China is conducting currently. Again, the accusation stands, accusation is there. The question is from us as macroeconomists' point of view is China doing that in order to manipulate the trade conditions in favor of its exporters, or does it do it in order to sustain some sort of the gradual, if you want, reduction of pressures in terms of the debt bubble that has been growing in China in recent years? It's an open question. Whether the United States will be able to dispute that successfully and come to some sort of a conclusion and agreement between US and China on it is a very open issue in itself. Beyond that, of course, Donald Trump has promised to deliver significant growth in the Rust Belt economy, in the manufacturing economy in the United States, and he clearly sees China as the major threat, competitor in that space. Unfortunately, the measures that he was talking about during the period of campaigning, such as direct tariffs imposition, restrictions and import quotas potential, these are regressive measures from the point of view of the US economy, simply because the manufacturing processes globally are so much integrated that it would be very difficult for the United States to significantly restrict trade with a major trading partner like China.
All right, so let's leave Asia. Let's talk about California. You live in California now. Are you ready to start topping up your CalPERS, pensioners, with a big increase in your taxes, Konstantin? Are you happy to do this?
Well, I'm not a public sector employee, so from my point of view, CalPERS is something that exists as a tax on people like myself. So yes, indeed, CalPERS, California Public Employee Retirement System, is a massive behemoth in terms of the state insolvency here. It's an 85-year-old institution, and for the first time in its history, currently, it is drastically cutting benefits for public retirees across some of the geographies.
Let me just jump in, Konstantin, because the problems there are that they were making wild assumptions about the returns that they could make, 7, 8%, in an interest rate environment of 1%. Is that malfeasance? Is that bad economics? Is it fraud? How did they so catastrophically get it wrong, Konstantin?
I think it is a combination of politics and bad economics, bad politics and bad economics. So CalPERS pension debt is roughly 164 billion US dollars currently. And it's mostly, and it is highly likely that it will grow significantly in coming years due to a combination of political interference and policy setting, but also demographics. So demographics of aging we're all familiar with. On the political side is CalPERS basically is underwriting luxurious pension benefits for the public sector here in California, the state of California public sector. You have the systems of pensions which effectively guarantee millionaires levels of pensions for ordinary employees in the public sector here. That is, it's a political decision that the politicians in California has made, in Sacramento have made over the decades. So equally in line with it, over the decades, CalPERS predicted that its investments would earn 7.5% return. As you mentioned, it's between 7.5% and 8%, depending on different years. This is what we call discount rate. And this, what it means is that a higher discount rate, like say 7.5% or 8%, allows politicians in Sacramento to avoid raising taxes or cut spending in order to meet their obligations to public sector employees, which are contractual obligations. They cannot be broken by the state of California. So a lower discount rate requires cities and municipalities and different public authorities to pay more each year into the pension fund to keep it solvent. CalPERS is actually considering cutting today this discount rate to just 6.4%. And they are saying that that will reflect what it expects to be smaller returns in the future. That will require cities, towns, and other municipalities, different entities of the public sector here in the CalPERS system to pay more money to cover their employees' pensions. Some will have to raise taxes, some will have to raise fees on users of their services and so forth. This is in a state which has one of the highest state tax levels in the whole Union of the United States. Worse, 6.4% that they are talking about cutting this discount rate to is quite unrealistic, as you mentioned, because of the low interest rates, because of the financial insolvencies in the system, and because of the already existent structure of taxation in California. The actual discount rate CalPERS can possibly really deliver on is probably closer to 4, maybe 4.5, maximum 5%. As long as they're staying out of recognizing that reality, that the true discount rate has to be lower, CalPERS will remain insolvent. But it will allow the municipalities, it will allow local authorities, it will allow different public agencies to stay out of increasing taxation in California.
Right. So they're about 50% off the mark, even at this time. Well, let's leave California and go to Italy. You've previously lived in Italy. What do you make of the world's oldest bank getting a bailout thanks to the generosity of the Italian taxpayer? Of course, I'm talking about Monte dei Paschi.
Well, yes, indeed. The world's oldest bank is about to go into its third bailout in history. It was bailed out twice before, including by the Medici family. It's a very interesting dynamic. Monte dei Paschi has been effectively on a life support for a number of years now. Italian governments in the past have resisted doing anything with it. Now it all comes to the push because there's simply nowhere to run anymore. Monte dei Paschi's stock has collapsed. Its equity capital has disappeared, evaporated. It has failed the stress tests repeatedly now. And the European Central Bank has found that the Monte dei Paschi, which is a systemically important institution, it's the third largest bank in Italy in terms of lending, in terms of its book, will need about 8 to 8.8 billion worth of fresh capital, which it can't raise. So the story went that they were trying to raise it from the sovereign wealth funds out in the Middle East, that they were trying to raise it from the oil-rich economies, and they failed. So Monte dei Paschi's problems are very interesting from the Italian banking point of view because they're relatively unique. Monte dei Paschi got into this trouble not because of its poor lending practices, which are there in the first place, but really because it acquired a smaller bank right before the global financial crisis has hit, and it acquired it in a very highly leveraged buyout. So that made Monte dei Paschi very large by Italian standards within the Italian economy, but it also made it unsustainable. If you look at the rest of the Italian banking system, there is a larger number of smaller banks which are teetering on the verge of, basically failing as well.
All right, sorry, got to cut it off there. Constantine, thanks for being on the Keiser Report.
Delighted to be with you, Max.
All right, well, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Konstantin Georgiev of macroview.eu. If you want to get in touch on Twitter, it's Keiser Report. Until next time, bye, y'all.